Let's set the stage. The year is 2026. A massive energy crisis just erupted, the biggest one in history. And get this, China is walking into this crisis holding 3 times the strategic oil reserves of the United States. Now that's not just a statistic, it's a huge strategic imbalance. In this explainer, we're going to break down exactly how this imbalance creates a really unique opportunity called the empty reserve trade, and how it's going to redefine the next 18 months of energy markets.
Alright, so here's how we're going to tackle this. First, we'll look at the geopolitical shock that lights the fuse. Then, we'll dig into that massive reserve gap between the US and China. After that, we'll get into the nitty-gritty of why a really common investment strategy is actually a hidden trap. We'll uncover the clever financial play the US is using to refill its tanks. And finally, we're going to pinpoint the real, hidden opportunity in all this chaos.
Okay, first up, the catalyst. We've got to understand the one event that completely rewrites the rulebook for the global energy market, basically turning a world of plenty into one of serious scarcity, almost overnight.
So on March 4th, 2026, the world's most critical energy choke point just slams shut. The Strait of Hormuz. I mean, this is the artery that 1/5 of the entire planet's oil flows through. So when it closes, it's not some minor hiccup. It's like a massive sudden heart attack for the global economy. This becomes the largest single supply shock in history.
Now, what's really wild is just how fast and how violently the market reacts. I mean, look at this. Before the crisis, Brent crude's just kind of chilling around a stable $70 a barrel. After the blockade, it rockets into triple digits, hitting $100, $120. And the daily traffic, 20 million barrels a day, it just stops. This isn't just about price anymore. It's a physical crisis. The oil is literally not moving.
But you know, that immediate price spike, that's just the big, flashy headline. The deeper, more strategic story has been quietly building in the background for years. It's really a tale of two superpowers and a massive, kind of dangerous imbalance in their energy security.
And this chart right here lays out the core problem perfectly. As we head into this crisis, China is sitting on a staggering 1.4 billion barrels of total strategic oil. That's combining their government and commercial stockpiles. The United States total, just 824 million. That is not a small gap. China basically built this enormous shock absorber for its economy, giving it an incredible leg up in weathering the storm.
So the big question is, how on earth did this even happen? Well, this timeline tells the story from the US side of things. The Strategic Petroleum Reserve, or the SPR, has been getting drained pretty steadily. You can see that massive drop in 2022. That's when 180 million barrels were released to deal with the fallout from the Russia-Ukraine conflict. The refills since then, they've been slow, they've been small, and it's left the SPR at its lowest level in over 40 years, right when it's needed the most.
So while the US was draining its reserves, China was playing chess. They were running this masterful stockpiling strategy. They didn't just fill government tanks, they blended state and commercial reserves together, creating this huge kind of murky cushion. In 2025 alone, they were adding over 1 million barrels a day. And the smartest part? They were buying up sanctioned oil from places like Iran and Russia at huge discounts. They were basically getting their energy insurance on sale.
Now let's look at how this crisis actually creates a huge problem for the average person trying to invest. Because when prices are going through the roof, the most obvious move seems super simple, but as we're about to see, it's a total trap.
Okay, so you see oil prices skyrocketing, and you think, hey, I'll buy an oil ETF, something like the popular USO fund, and I'll ride this wave up. It seems totally logical, right? But it's based on a really deep misunderstanding of how these products actually work. For a lot of people, this seemingly smart move is actually a gateway to losing money, even if they're right about where oil prices are headed.
So to get why it's a trap, you have to understand the shape of the market. Normally, the oil market is in what's called contango. That just means the price for oil delivered in the future is a little higher than today's price to cover things like storage costs. But in a crisis like the one we're talking about, the market flips into backwardation. The need for oil right now is so desperate that today's price is much higher than the future price. And that flip, that changes everything.
See, an ETF like USO doesn't own big tanks of physical oil. It owns futures contracts. And every single month, it has to sell the contract that's about to expire and buy the next one out, just to stay invested. This whole process creates something called roll yield. The easiest way to think about it is like a transaction fee. In a normal contango market, the ETF is forced to sell a cheaper contract and buy a more expensive one. It's systematically selling low and buying high, over and over.
And here is the brutal truth about that process. Over time, in a normal market, that constant cost of rolling contracts forward can chew up 5 to 10% of the fund's value every single year. It is a slow, steady bleed that happens even if the actual price of oil doesn't move an inch. It's a structural flaw that just punishes anyone trying to buy and hold.
So the U.S. has empty reserves, and the most popular investment tools are a trap for anyone who isn't prepared. So what does the government do? Well, it turns to a surprisingly slick financial play to solve its problem.
The strategy is called temporal arbitrage, which is really just a fancy way of saying they're exploiting the difference in prices over time. They're using the very market structure we just talked about, that state of extreme backwardation, to turn their own vulnerability into a financial win, refilling the reserve without needing a single new dollar from taxpayers. Pretty smart.
Here's how this brilliant swap works, in 3 simple steps. First, the government sells a barrel of oil from its reserves today, at the crazy high crisis price, let's say $96. Step 2, they immediately take that $96 and use it to buy a contract to have oil delivered back to them in the future, when the price is way lower, maybe $71. And then, step 3, because of that $25 price difference, they can buy back more oil than they sold. They get their barrel back, plus a little extra, and the whole thing is paid for by the market itself.
So this is the key. If the government is playing arbitrage games in the futures market and retail ETFs are structurally flawed, where is the real lasting opportunity for an investor in all this?
The real national security arbitrage here isn't a bet on the price of oil going up or down. It's a bet on the physical world. The opportunity is in the boring, essential, absolutely irreplaceable infrastructure. The pipelines, the storage tanks, the export terminals. This is the midstream sector. Think of it as the plumbing of the energy world.
And here is the secret sauce for this sector in a crisis. The vast majority of revenue for these midstream companies, we're talking 91% on average, is based on fees. They're basically toll booth operators on an energy highway. They get paid for the volume of oil that moves through their system, and they couldn't care less if that oil is worth $70 or $120. It completely insulates them from all the wild price swings.
And this table gives you a sense of the major players in this space. You've got absolute giants like Enbridge, which moves almost a third of all the crude oil in North America, and Energy Transfer with its massive web of pipelines. These aren't speculative little companies, they're the bedrock of the energy world, and their assets become absolutely critical when physical supply gets this tight.
Let's just zoom in on one example, Enterprise Products Partners, or EPD. This company is uniquely positioned for this empty reserve trade. I mean, it's got a rock-solid A- credit rating and an incredible track record, 27 years of uninterrupted payouts to investors. And here's the key. It's bringing new storage assets online right in 2026, and its infrastructure is absolutely essential for the government to actually pull off those no-cost SPR swaps we talked about. EPD is sitting right at the physical center of this entire trade. So, let's wrap this up with the key takeaways. First, that huge strategic reserve gap between the US and China, that's the new defining feature of global energy security. Second, the US government isn't just a passive guardian of oil anymore. It's an active financial player, using arbitrage to manage its reserves. Third, be super careful with commodity ETFs. Their internal mechanics can make them a serious value trap. And finally, the most durable investment play, the safe alpha, is in those fee-based midstream companies that own all the essential plumbing.
You know, when it's all said and done, this whole crisis reveals a deep truth about the modern energy market. In an age that's going to be defined by geopolitical shocks and crazy volatility, real power doesn't just come from owning the resource itself. The real, lasting value comes from having the physical capacity to control it, to store it, and to transport it. Physical control is now way more valuable than paper speculation.
And that leaves us with one last big thought. We've just uncovered a massive national security arbitrage in the oil market, and it was born from a huge imbalance in physical stuff. So, as this kind of geopolitical risk becomes the new normal, you have to ask yourself, what other critical sectors out there, from food to microchips to rare earth minerals, have similar imbalances hiding just below the surface, just waiting for the next crisis to bring them out into the open?